break down tokenizing debt. Now, for one, I'm gonna be doing these live streams a bit more often just because it helps me flow a little bit better. Got this new whiteboard, got a little bit of this new setup, but got this new mic, of course, that's definitely needed. Before I do anything, let's do a mic check. So anybody in the chat, is the mic coming up all right for you guys? I actually got a lapel mic, so this should be like pretty straight. Um, Hopefully we're good. If you just type okay if you guys can hear all right. But we're here to talk about tokenizing debt and what does that actually mean. Ooh, looks like you can't see the whole board. Ooh. Here, we'll start down here and I'll move it back up there. So there's two things. One, we need to break down what I know I have this teeny tiny little set here, but we'll break down what an NFT is, what that means in regards to tokenizing a debt contract, talk about different types of debt, and then we'll go into this example I have up here. And I know this is a little makeshift, but whatever. Let's do with it. Let's go with it. So, an NFT. This is something I'm going to break down every single time I do a. This is something I'm going to break down every single time I do a video, but seems like everyone seems to think that NFTs are just like cat pictures or just random pictures. Can I turn up the volume? There you go. How's that? Ooh. Anywho, the biggest thing is I want to be able to hammer in what an NFT is, right? So look at this, right? This is a smart contract, and in a smart contract we have different indexes. That's usually dictated as the token, what's being tokenized. Then we have a URI, which is a uniform resource identifier, but and all that is just a piece of metadata stored inside the smart contract to show and really describe what the smart contract is. That's usually where people put the links for typical NFTs and just call it an NFT, or the link to the picture, whatever it means, and call it an NFT. So we've got the index representing the token. You have multiple indexes that will cycle through different types of tokens. You have your URI that has the metadata describing it. You have the contract, which would basically be whatever you want it to do. It could say whatever you want, and it can do whatever you want in terms of being able to automate that. And that essentially is the structure of an NFT. This contract can do whatever you want. The token associated with it is just pointing to this contract. Now, to the main thing. So let's talk about tokenizing debt. Well, what are typical ways people tokenize debt already? And I wrote these down over here. I got CLOs, CDOs, and ABSs. So CLOs are collateralized loan obligations, CDOs are collateralized debt obligations, and ABS are asset-backed securities. Now, I'm not going to dive deep into what they are, but what I'm about to show here can be applied to all three. So let me raise this back up. Here we are. So here's my little example here of what does tokenizing debt look like. Now, with the examples I gave for CLOs, CDOs, and ABSs, these are just traditional debt contracts that already work in our current established economy. And the reason I brought that up was to show people that debt isn't just you, well, it is people lending money, but it's not just you accepting that money. That debt in itself is an asset. And if I were to lend someone money and I was to lend somebody money at an interest rate, well, that is a revenue generating asset due to the fact that I believe I'll make more money off of the contract I provided, which is this debt. Now, what does this look like in terms of how people move debt and how can we tokenize this? These are like the two big things that I really want to hammer in, because with debt being a revenue generating asset, that means that the debt holds value. And as it holds value, it can be traded. And just like any other asset, when it's traded, it will contribute volume to these different networks. And when it's automated, it will essentially allow for different tasks that would otherwise be done by accountants, lawyers, and a series of businesses to exchange different rights over different assets. The asset being debt in this scenario can now be entirely automated to what we showed before as a smart contract. And I'll go into how that looks. So I got my little diagram here. I hope you guys can see it all right. I try to make it as big as possible. So I got my little diagram here, and we got our little lender dude, and we got our little debtor dude. And let's say the debtor is taking out student loans, because that's always a fun topic, right? And let's say the lender gives the debtor $100 for student loans, right? Whatever, gives them $100. And that $100 has a 5% interest rate. Well, what you could do in terms of tokenizing that debt is that same debt contract that would otherwise exist in any other capacity can now be tokenized, just like we showed with the contract. So you have the contract, you have a token pointing to the contract, and this lender will now hold that token. Now, that smart contract will just automate the interest rate and basically keep track of the payments made by the person who took out that debt. It's great because now you essentially took out all that additional accounting, and all that maintenance for managing that back-end system for the accounting is now managed on the blockchain in a smart contract. But what ends up being really cool, especially with being able to tokenize these assets and tokenize these debt, is just like traditional debt, you'd be able to sell it. And let me just show you how a lot of this debt ends up being sold. I actually have like really strong opinions about it, but I won't get too into it. I'll show you how it ends up being sold. So let's say I've got the first original lender, and he lent out $100 for a 5% interest rate. Well, now that debt contract is worth $105 because at the end of the period in term in which people pay it back, that debt is expecting to make $105 off of the $100 investment. So the original lender could go, I could sit here for the next year or two until this guy pays me back, or I could just take my debt and sell it to the next guy for $101, let him hold on to it until it matures, make my $1 in profit, and be able to be, boom, ready to go. Now, this goes further and further and further ahead. So I even have this guy selling it for 100, from buying it for 101, selling it for 103. This guy may keep selling it as the profit margin keeps falling. And then eventually, let's say the last guy holding it, the debtor never paid off their debts and they sell it to a collections person because, hey, look, I just want to be able to write it off. I want to get whatever I can get for it, and whoever's willing to take it and be able to walk through collections with it ends up being, it's your problem now. So the cool thing about this in terms of being able to tokenize assets on the blockchain is, well, you got to remember, as other assets reside on the blockchain, whether it's stocks or bonds or whatever, those exchange of those assets will contribute to the demand for the network. So if that debt was worth $100 and you sold it to somebody, they're going to need to provide $100 worth of value to purchase that debt. And if that is all residing on the blockchain, that is additional demand for the network to be able to participate in basically e-commerce on these networks. It's no different than if somebody sold a stock for $100 in terms of how much demand is pushing towards the network. The only thing that's interesting about this is that $100 was just lent money that's just contractually agreed upon that it will be paid back. That's essentially the value proposition, on top of the interest, of course. But what ends up being really cool about this is debt ends up becoming leveraged upon itself. And what I can really show, I can show what I mean by that in terms of, let's say, and this is kind of the magic of debt that's different than a lot of these other assets. So we went through that whole basic process of someone, issues the debt, then sells it, and they keep on selling it. Maybe the last person holds it, makes some money. Maybe they sell it to a collector because they don't believe they'll make it, whatever. But what you can end up doing is, because the debt itself is a revenue generating asset, and because it's worth something, you could take that debt and use it as collateral to take out more debt. So let's say this guy bought this debt token for $110, and he's like, look, I want to hold on to it, but I want to be able to do more with my money. So let's say he takes that debt NFT and he locks it up in some sort of collateralized contract, and he says this debt is worth $100. Let's say he just says it's worth $100, and he wants to take $25 worth of credit from another lender. Let's say you got little Bobby over here who's willing to have him collateralize his debt and then issue him another $25 off of that. Well, you just took money that was borrowed and you are able to leverage that borrowed asset for more capital. And every time you do that is more demand for the network. And it's just, like I said, it's just like how when you trade stocks or trade bonds on these networks, you need the network token, or at least you need tokens on the network to be able to exchange that value. But with debt, you can leverage debt upon itself. And this is something that already happens. You could look at fractional reserve banking, or you could just look at just like traditional like finance in terms of what's good debt, bad debt in the corporate sense. And you could take something that's already debt and leverage it upon itself for capital, and then essentially use that to buy either more debt or more equities or more whatever. But what that ends up doing is all of that still perpetuates demand for the network, just like you would buying any other asset. The thing that's interesting is the fact that you can leverage it on top of itself for either more debt or being able to use that debt as collateral for something else just shows that even though the $100 that was essentially the $100 passed along the network as volume can essentially be used as collateral for other things or other means. And just that agreement itself is what holds the value. Technically, the minimum payment holds the value because the idea is if they stop paying, it's not worth anything. So as long as you got this guy over here paying into this contract, that contract's worth something, and that contract can be traded like any other asset. It's kind of one of the cool things about how debt works in general. But don't get me into CLOs or CDOs and everything, but it could turn that into a giant leveraging mess. But for the general concept I'm trying to portray is all of those different mechanisms for being able to issue debt, manage debt, and be able to trade debt can all reside on the blockchain in regards to people passing these contracts around as if they were like any other asset or any other token. And as people pass these tokens around or pass this debt around or these debt contracts, they're contributing more and more to the network volume in terms of people being able to trade value on the network. And the more people do this, like I said, we started off with $100. This guy had $100 on the network. But as he kept on selling it, that was another hundred or so dollars contributing to the volume in the network to pass that asset, which was really just a packaged $100 contract saying that it'd be paid back at a later date. And that's the thing. You, like I said, someone could take that contract, put it into another contract that's collateral, and be able to take credit out on that, be able to use that to lend out to somebody else, and then sell that, be able to use that, and then keep on going and keep on. This already happens in the traditional markets. But the only difference is you can entirely automate this, and you can basically tokenize the rights to that debt, to that contract, to whatever, and be able to use that as a means to prove or at least show that you are the current holder of this contractual agreement. And the idea too is these don't have to be as sophisticated as people are thinking of. Like sometimes people think of, are these going to be entirely automated and it can give away everything? It could, very much could, or it could be no different than the smart contract representing the piece of paper otherwise would have represented, and the token basically being the holder of that contract, and then you just have a native means of passing that token around that's no different than a piece of paper. It could be just the same, where if you need to seek out litigation or you need to sue the person you lent to or whatever because they weren't paying, you may just go to court and just say, Your Honor, I hold the token, my address, I am the holder of this debt, and this person is not paying. It could literally be as simple as that, or it could be as convoluted as a entirely automated debt system in terms of people being able to loan and being able to lend and loan different assets to each other in terms of being able to pass that overall contract around too. And one of the main reasons I wanted to go over this is I hear the term a lot, all the money. And when people think of that, they think of like the absolute value of capital. So they think of cash, they think of maybe like abstract values in terms of stocks in a sense and being able to liquidate them. But we don't think of credit and debt. And the thing that's really interesting about that is, and this goes for all fiat systems, they're oh goodness, what's the term? All fiat systems are oh goodness, it's slipping my mind right now. Oh gosh, it's slipping my mind. Anywho, they're all based on debt, and the idea is that what is it? Fractional reserve banking. That's what it is. They're all based off fractional reserve banking, which is basically being able to leverage assets that already exist and then being able to lend out debt in reference to those assets based off of a certain ratio, usually 10 to 1. So when people say all the money, well, if you thought there was $1 trillion, or let's say what's after quadrillion dollars, let's say there was $1 quadrillion, well, you could probably confidently say that there's $10 quadrillion of debt, just based on the fact that people leverage capital out there in terms of being able to issue out more value in the form of it being paid back in these contracts. But when you tokenize these contracts and you trade these contracts like you would any other asset, you end up seeing that debt itself becomes even bigger than a lot of these other asset classes, simply based on the fact that it's just capital locked up into a agreement that should be paid off over time based off of a interest rate. And with that ends up becoming a whole new host of like, holy cow, like how much value can come into these networks simply based off people taking money that already exists and then being able to lend it out. Then we get into the idea of, well, now that you have a more liquid, automated, and faster means of being able to trade these assets, you may end up just seeing the overall volume of these traditional markets that would otherwise be trading this debt otherwise increase, simply based on the fact that it's easier. You can anyone that's operating on these networks can very easily interact with anybody else at all. So you wouldn't have to go through these different exchanges or these different brokers or these different wealth management firms. You could literally even almost be like a regular Joe Blow and be able to hold different assets simply based on being on the same network as everyone else who's issuing these assets. And the thing that's really interesting about that is that's never been done before. If you were, some giant wealth management advisor and you wanted to get in on like a CLO or something, you'd have to go through a series of brokers or exchanges or other wealth management advisors, and then there'd be all this different bureaucracy in terms of managing the assets and managing and checking and all these different things, in which a smart contract can do automatically. A smart contract can check and see, hey, did somebody pay their minimum payment this month? Did somebody was this token passed on to somebody else, and what would that mean in terms of And was the token to pass off to somebody else, and what would that means in terms of passing the rights over? Uh, Now that anybody can operate on these networks, anybody that creates a smart contract that can interact with these tokens can now have a means of automating something they would have already bought manually otherwise. And the cool thing about that is right now there really isn't. This is sort of where the idea of DeFi comes into play. There really aren't many things in terms of being able to manage assets like this programmatically. It's usually just some third party dealing with their different departments that manage your assets, and basically if they manage it wrong you could maybe pursue them legally, but the idea is there wouldn't be a handling these assets wrong if it's entirely automated due to the fact that these are all hosted by smart contracts on these decentralized networks. Whew. Anywho, I might actually get into a little bit of questions. So if you have any questions, super chats, whatever, definitely throw them down there. One of the biggest things I did want to hit on too a little bit is, so one thing that can be really interesting with smart contracts is not only can you manage the environment that these tokens will reside in, but you no longer need like these different third parties that would otherwise host what's it called? That would otherwise hold on to the physical asset. Because you got to remember, the main reason why anybody has a broker is because nobody holds their physical. Let's say it was a stock or a bond or whatever. Nobody holds that. Maybe some institution does, but now anybody can hold any of this. Like, it sounds goofy to say this, but if you wanted to invest in somebody's student loan in the form of like a CLO or something in a bunch of bundled up debt contracts, and that contract or that debt has a 20% interest rate on it, well, now that's an asset that has a 20% interest rate that the average person will now have access to invest in solely based on the fact that everybody on these networks can interact with anybody else on the networks. You don't necessarily have to be a giant institution to have privy or access to these different financial instruments, or at the very least, you can make it so easy that literally anybody on the internet can have access to any financial instrument. Which, like I said before, it's never been done before. Like, I bet a lot of you guys have never even thought about owning somebody else's debt in terms of being able to make passive income off that, or being able to make interest rate income off that. And maybe you've thought about that too, but most of the time what comes to mind is, oh, I loaned Johnny $20. I hope he pays me back. But hey, imagine being able to loan $20 in a smart contract, have an interest rate on top of that, and then selling that smart contract token to somebody else for $22 or whatever, and being able to pass it along that way. Now, this also comes into a whole new question of, well, how would essentially like being able to check credit work, and how would be able to manage these how would you be able to manage the other side of the debt in terms of being able to issue debt? Now, one thing I'm thinking was going to end up happening is we'll end up seeing what's it called, like identity KYC contracts, and then with that identity KYC contract, it may be like a government issued contract in a sense, where it's no different than your ID. It's just on the blockchain. And with that, you could basically show that you could take out any debt or hold any asset in your KYC contract, and then all of those different tokens can correlate to different smart contracts, and people can see where how much debt you've been taking out, how much of your credit you've paid back over time. They'd be able to see all of that simply by you holding these tokens on the other side. So let me put a little token over here. So if you're this debtor guy over here, and you want to be able to show that you've paid your debts off before, you'd be able to collect these tokens from every single contract you've engaged with. Let's say you pay it off. Well, now that you hold these tokens are almost a means of proof of being able to show your means of being able to pay back debt. And it may be one of those things where, because you could create the token however you want, it may be that the token gets issued to your address, and maybe it's considered in a pending state, and it may have a default state and a completed state. And being able to show these completed state tokens for different contracts you've engaged with can help be used as a mean to take out more credit in the future by other lenders, seeing that you've been able to take out debt from other contracts and show the tokens that you've been able to pay them back. But I think this is gonna be a whole new world of decentralized finance that's really gonna in my opinion revolve almost entirely around debt. Like I said, these fiat systems are fractional reserve systems almost entirely predicated off debt. It's almost entirely predicated off the idea that as long as you have people paying debt and people engaging in these economic services that will encourage economic output and being able to lend to those people to catalyze that economic output, is entirely based off like the modern is entirely oh goodness, let me see if I can get this right, is the entire basis of the modern economies today, essentially. And people think of all the money, but people don't think all the debt. And all the debt really is all the money. Anywho, any questions? Because I think that's sort of what I had here. I try to make these, or at least what I'm trying to do, is I want to make these feel more like, I don't know, I don't consider myself like a teacher or anything, but definitely feel more like a classroom basic setting. I know a lot of other YouTubers do like a whole bunch of stuff, whole setup, everything. If I can get the idea from here into your brains, that's kind of my main point with everything. So, anywho, any questions? Any questions? I see a lot of people in real estate, first plate, passive income, da da da. Yeah, if there are any questions, definitely throw them in the super chat because I'm there's just too many chats going by. Sorry about that. Um, Anywho, I hope you guys enjoyed this. I'll give you a couple more minutes just in case anybody else has anything to add. Um, but yeah, my biggest thing is to really show all the different opportunities that can be done simply with blockchain technologies and how you can essentially automate these tasks that already exist. Like I said, the idea of automating or tokenizing debt, or I wouldn't say that, but the idea of being able to sell debt already exists. There's CLOs, CDOs, asset-backed securities. Like there are all these different means of being able to tokenize debt or be able to sell debt. Why not tokenize that and then be able to sell it to anybody that resides on the network? Or at the very least, be able to automate the process in which people engage with each other in these debts. Being able to automate the debt itself. Like, I wonder how much money, it sounds goofy to say this, I wonder how much money is spent just keeping track of interest rates. Of like, you're an institution, you lent out a ton of money. Like, how much money is being spent of just different people trying to make sure that, okay, this was paid, this is the interest rate, this is paid, da da da, maybe I sell it to somebody else. Like, these are, and I've seen a little bit of this before, but the biggest thing that becomes this huge thing for me is it seems like you need almost giant organizations to do something that like three smart contracts could potentially do. That's literally as simple as that. You have a smart contract that holds the debt. Maybe you have another smart contract that manages the use of that debt and manages the what's it called, different parameters and how that's able to be used, or at the very least manage the parameters on how this person is able to pay it, and maybe just an ecosystem of smart contracts in which people are able to trade these debt assets with each other, whether it's through wallets, whether it's through smart contracts, whether it's through other institutions, just automated means of being able to trade with each other without having these different brokers and management firms and all these different things in the way that really bring a lot of friction. Whew. Anywho, I see someone asking how credibility can be tokenized. Credit should be able to have tangible value other than the ability to take out more debt. I mean, you can get into the idea of like collateral backed debt. Actually, I might dive into that real quick. So let's say you had, because this could be really cool. I sort of said that idea of leveraging debt on itself, but let's say you had a debt contract and you wanted to take out $100 worth of value. So you put $25 worth of stock, you know, this is $25 with the stock. I'm writing it sideways, so it's hard to actually. There we go. And let's say you wanted to. Let's say you wanted to take out $100. There's $25 worth of stock. All right, cool. So let's say you wanted to collateralize $25 worth of stock to take out $100 worth of credit. Well, you could potentially do this with these contracts in which the stock itself is an NFT, and then the collateralized contract that it resides in is also an NFT. And then let's presume that you don't pay your debts. Let's say this asset that resides in this contract automatically goes to the lender simply based on the idea of you being able to automate collateralized assets within debt contracts. And this could be its own, like there are whole markets in terms of just that, being able to take assets that already exist, collateralize them to take out short-term capital, and then once they take that short-term capital, they run their businesses with it, and then usually it's whether they're company stocks or bonds or whatever, and then make payments over time, realizing that they can consider that good debt based off of them growing their business and taking certain pieces of collateral and using that to take out that short-term capital or whatever capital that they may need to take out. This, in my opinion, actually I believe like collateralized debt makes a lot more sense than just like trust debt. Obviously, because if you don't pay, they just get the underlying principal rather than trust debt just going, Cool. Hope you pay me back. And obviously, if you're over here, this guy, you may go, I don't know if he's going to pay me back. So you may sell it to somebody else and hope that they pay them back, making sure that you capitalize off of that short term gain right there. But, oh, I got a question here. Oh, well, thank you too, Mr. Immortal Space Cadet. Anywho, yeah, I definitely want to do these more often. I want this to be like sort of a weekly thing. Have these streams twice a week. Go into different topics. Next topic, actually, not next topic. Next video, I might be doing a redo of the XDC versus XRP different capabilities vid. Might be a little bit shorter than the last one because I got a little bit of a better setup. Mostly the better mic, really. And I hope the stream's coming out all right. I literally shut down all my devices to make sure that it wasn't lagging on my internet. But I hope these are going to be more of a I hope this is going to be more of a routine thing, and I'm definitely like a lot more comfortable just doing these streams rather than the videos. The videos take so much time, and I usually like try to get up and make them interesting. But I figured if I can just come on here and just free rant on just different topics, just as a as an individualized topic, sort of like I said, sort of in the idea of like I'm no professor or anything, but if I can give you sort of that like classroom vibes of like the whiteboard and then the idea, and you can get the idea, that's kind of all I'm going for. So I don't think there are any more questions. I think that's going to be it for this stream. I hope you guys love it, and I will see you on the next one. Peace.